Hey everyone, this is Greg Miller from Spinoff Investing Simplified. I'm your host here at Spinoff Investing Simplified's YouTube channel. And I appreciate you stopping by and taking a look around. If you appreciate this video or any of the others, please subscribe to our channel. We would love to have you along. We also appreciate your comments, and smashing that like button helps us out with the YouTube algorithm. We sure appreciate your time with us and hope you enjoy this video. Thanks a bunch. Hey everyone, this is Greg Miller coming back at you from spinoffinvestingsimplified.com. I'm really excited to be with you guys today and share another video of some of my thoughts. This last week, and actually for about the last month and a half or so, a lot of us have been dealing with the coronavirus, and it's been fascinating to me to notice some of the things that are going on with the coronavirus and how people are, there's a little bit of fear out there. There's a little bit of concern. And I wanted to spend a little bit of time talking about some of the things that you might want to pay attention to when you're in your investing practice. I am not one to think that I fear things. However, I know that that is a very frustrating thing, myself included. I know that I have fears. And one of the things that we as investors should be doing is spending our time understanding that. And so for that, I'm going to share with you a little bit about biases. And I think that it's important that we understand what those biases are and how they affect us today. So let's jump into this and see what we can find. So before I get started, I want to be very honest with you guys as much as I can be, just because I know that I have biases. And so here are some of my own personal biases that I think affect the way that I think. And everyone should, in my view, do an exercise like this to kind of understand themselves if they want to invest in individual stocks. So particularly, I think about spin-off investing, and I want to focus on specific biases I might have for spin-offs. I have a bias for investing in spin-offs, and that is an incentive bias. I want to earn more with my money than I would get through investing in a mutual fund or an exchange traded fund or something that is based on the market. Or something that is based on specific market indexes like the S&P 500. And so my incentive bias is why I'm here. It's probably why most people do investing and why they start spending their time looking at investing on their own. And then my biases go further steps into this. And I think the problem is when we have biases that are all converging together, that's when we know that we're probably either making a mistake or we're doing the right thing. And here's where my other biases are. I have a liking bias. I like the idea of spending time understanding a company and valuing it. I also like the people that are typically considered value type investors like Warren Buffett, Charlie Munger, Joel Greenblatt, a lot of those people that work in this type of career field. I like their thought processes. I also have a dislike for the financial products in industries. So my disliking bias is based on my own personal experience, and maybe you've heard me tell the story before, but when I was very young, when I was in high school, I wanted to start investing in the stock market. And so what I did is I went into, I'm not going to tell you which company, but I went into a broker, and I asked them to put me into some mutual funds. And so I picked one of the mutual funds, and that broker, instead of really caring about what I was doing, he was just like, yeah, whatever, and I put $500 in a mutual fund that went worldwide, and I did that in about 96. And I put that money in there, and I expected it to grow over time as he promised it would. And I went through it, and In 2012, I went back and revisited that investment. I didn't add any more or anything like that. I just kind of looked at it and, nope, I'm just going to go ahead and put that money into there and then just leave it for several years, thinking that that is the right way to approach things. Well, at the end of those 15 or 16 years or so, that particular mutual fund had a negative return on investment for me. And part of that is due to the amount of fees that were caused. The other part was the fact that it was in a riskier section of the market. But the biggest problem was when I walked in to cash out that mutual fund. I went in and I talked to the new salesperson. Someone else had bought out the book of business from this prior broker, and he spent some time trying to convince me that I shouldn't take the money out. And I was taking the money out, and I told him for a specific reason. I wanted to take it out to build some cash to purchase an investment property. Now, 2012, I'd spent my time doing a lot of research on investment properties and stuff like that. And I was like, yeah, this is probably a pretty decent time to purchase this house. And we can get into it and not have a very high overhead, and we know that the rents will cover it more than adequately, and it's something that we're going to really benefit from. And so he spent a good half hour trying to convince me that that was the wrong perspective. And then he told me of his own experience buying a house and how he had $200 outflow every month from it. And I was like, well, you obviously didn't do the numbers. And that actually brings me into my last bias, my excessive self-regard. I had a lot of frustration with that. And then I finally got so frustrated with him, and this is the disliking and the self-regard biases coming together with my own investing. And that is, I told him, okay, how much money is in that account? And I knew it because I'd looked it up before I came in to cash it out. And it was less than the original 500 that I put into it. And I specifically, being kind of the snotty kid that I was, I told him, okay, if it's such a good investment, then what did I put in originally and what happened? And yeah, maybe I wasn't as genuine as I should be, but I was really frustrated with that experience on investing through a mutual fund. And so for me, my investing bias is that I want to invest in individual companies if I can, and because I think I can do okay. I can do as well as the people that were managing my money at this mutual fund company. So those are my investing biases. And then I think the problem is there are so many biases out there that people don't realize that even our biases also affect individual investments. And we're going to talk about some of those. So some of the individual biases that I have seen present in myself when I research investments are the following. Doubt avoidance is one of those things. We don't want to have any doubts when we make a decision. And so it's easy for the human mind to push and push and push to find a solution, even if it's premature. This is a problem that happens in investing a lot. You know, do I doubt my numbers if I'm using the numbers to calculate how much a company is worth? And am I avoiding the rest of the work that needs to happen in order to actually make a good decision on that investment? The second one is coming to a preconceived conclusion or a first conclusion. Maybe we are very biased to certain metrics. And so if the numbers are right, then that turns into a single reason for a purchase. And instead of looking at the whole company as a whole, we sometimes make the mistake of looking at just one or two key elements. And if they're not the right key elements, that's where we can make mistakes in our biases. Greed and envy. Warren Buffett often talks about how the world revolves around envy. And I think that is a big deal. And I think that there's a lot of greed and envy that occurs around similar investments that people missed. One comes to mind. Some people say, oh yeah, I missed Apple. Well, who's to say that Apple was the only company at that time that would have made the market capitalization that they did and the turnaround that they did? Who's to say that, you could have a similar investment that was missed in a lot of different categories, and you have to understand why that investment might be missed. And then finally, there's an efficient market bias, and that one was perpetuated by my own education. And the frustrating part about that efficient market bias is that perpetuation in education continues to this day. And as Charlie Munger says, it's just easier to teach something that's really fascinating or a really interesting formula to teach than it is to actually focus on the money. And I do my best to be focused on the dollar bills as opposed to the beautiful calculations and stuff like that. Some mitigation techniques that I have found that help me out is, one of the things that I need to do is I need to continue to write out my doubts as quickly as possible. And I find as many as possible. So if I don't have a bunch of doubts that I have about an investment, then I probably haven't done enough research on that particular company. And then I identify reasons why the conclusions might be wrong. Charlie Munger talks about inverting these conclusions. So think about the other side. Why would someone want to sell this particular company at this time? And if they do, then are those reasons that I'm okay with? A great example of this, Garrett Motion, a company that I've been following for quite a bit lately. They are at a point where people are coming to the conclusion that the company is going to completely fall apart. And it's a possibility. It's a definite possibility. And you have to be able to hold that in there when you make a decision if you're going to invest in a company like that. On the other side, what are the conclusions that they might be wrong? Because people will also deal with this same bias, and understanding those biases will make a big difference in our investing. Before I invest in a company, I found that the more that I consider alternatives, the better I am. So considering alternatives includes keeping some cash around. I like to keep a significant portion of my portfolio in cash, because it seems like we have events that affect individual companies, or like the coronavirus right now, maybe even the entire market to a certain extent, that will provide buying opportunities for many investors. Understanding why an investment is a good opportunity. So you think back to that moment of the Apple situation. Why was it a good opportunity? Well, it might not have been a good opportunity until Steve Jobs came back and reinvented the company. And even then, as a returning manager, you could have looked at it and said, I don't know if that was the right decision at the moment, when it would have been the best potential investment opportunity for you. So a lot of these things are things that we can struggle with as individual investors, and understanding why an investment is a good opportunity, and then being comfortable with that reason why and the uncertainty that is involved around it, is something to think about. Establishing a price prior to looking at the price. Personal favorite. I don't like to look at market price. Market price will typically tell me what somebody else is trading that company at, but I'm not interested in what other people are paying for it. I'm more interested in what I am paying for it. And I made this mistake many times when I was a younger investor, where I just looked at the price and said, oh yeah, that's a pretty decent way to go. But instead, if I can focus on understanding why I think the price should be where it's at, then I can make sound investment decisions. And those are the things that I wanted to share with you guys this week. One of the things I want you to, I hope you're doing well, and I hope that you're staying safe. And thanks a lot for watching. As we finish up, we have one final note for you. This video was made for educational purposes only. Any companies mentioned in this presentation were discussed for educational purposes only. Discussing such companies and the specifics about them is for illustrative purposes only and not a solicitation to purchase them. We recommend that you conduct your own research and identify why you might want to own the company yourself before you commit any funds. We also recommend that you seek the services of a financial advisor that has considered your situation as your fiduciary. May your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks.